Welcome to Casa Academy, Chapter 14, Part 2, where we will cover real estate-related computations and closing of transactions. I'm genuinely super excited to dive into this material today. We've got a fantastic goal for this session. We are going to completely demystify the math and the logic behind closing statements. Look, I know that seeing a real estate closing document for the first time can feel incredibly overwhelming, kind of like reading a foreign language. But by exploring these concepts together, the really elegant, simple logic behind all these numbers is going to start revealing itself. This isn't just about preparing for your real estate pre-license exam, although you will absolutely be ready for that. It's about making sure you feel 100% confident in the real world when you sit down at the closing table with your future buyers and sellers. Here's our blueprint for today. 1. Understanding real estate prorations. 2. The double entry rule. 3. Prorating property taxes. 4. Handling rental income. 5. Interest on assumed loans. And 6. Summary and exam strategy. Section 1. Understanding real estate prorations. So closing day can honestly seem a little chaotic, right? You've got unpaid bills floating around, prepaid expenses, and two parties just trying to settle up fairly. Well, prorations are your absolute best tool for fairness in this process. By definition, proration is simply dividing a cost or income item between the parties according to the number of days each owns the property during the applicable period. Now, I want to reassure you right away. If you hear the word proration and your brain instantly panics thinking of some complicated calculus, stop right there. This math is literally just a highly logical division of days and money. We're just figuring out exactly how long the buyer owned the property versus how long the seller owned it in a given month or year, and then splitting the bill accordingly. It's really just about being fair. And to do this, there are 3 exact, highly repeatable steps you're going to follow every single time. Step 1, determine how many days belong to the buyer and how many belong to the seller. Now, a crucial, absolutely vital point here, the day of closing belongs to whoever the contract specifies. You always look to the contract. Step 2, identify who has already paid the expense or, if it hasn't been paid at all. Step 3, assign the debits and credits based on those facts. Honestly, if you just stick to these 3 steps, you literally cannot fail. Section 2, the double entry rule. Let's see how those steps build into our next core concept. This is kind of the golden rule for keeping every single closing statement perfectly balanced. Every debit to one party is matched by a credit to the other party. Prorations are always double entry items. That means one person's loss is the exact other person's gain. You are never going to see a proration where only one person gets charged and the money just vanishes into thin air. No way. If the buyer is debited $100, the seller is credited $100. They balance each other out perfectly, every time. It's actually super helpful to mentally contrast our 2 main scenarios as we prep for the exam. If an expense is prepaid by the seller, well, the seller is entitled to reimbursement for the buyer's share. So that's a debit to the buyer and a credit to the seller. But on the flip side, if an expense is unpaid, meaning it's paid in arrears, the seller hasn't paid their share yet, have they? The buyer's going to eventually get stuck with the whole bill. Because of that, the seller owes the buyer, resulting in a debit to the seller and a credit to the buyer. Makes sense, right? Section 3, prorating property taxes. Okay, now let's actually put those rules into practice with the first, and without a doubt, the most frequently tested example. The absolute most important thing to wrap your head around here is that in Florida, property taxes are paid in arrears. That simply means the taxes for the current year aren't due until a later date. The bill comes later. So property owners might start paying the bill in November, but during the summer months, those taxes are just quietly racking up unpaid. Oh, and real quick, before we dive into the math, your verification code is 598702. Let's look at exactly how paying in arrears impacts our buyers and sellers when they finally sit down at the closing table. Let's apply this to a real-world scenario. Imagine we've got a closing file, reference number 800913. This particular transaction is closing on May 15th, and the contract explicitly says the day of closing belongs to the buyer. So what does this actually mean for our proration? Well, it means the seller owned the property and is therefore on the hook for the taxes from January 1st all the way through May 14th. But remember what we just said? Taxes are in arrears. The seller hasn't paid a single dime for those days yet. Since the buyer is the one who's going to get hit with that massive tax bill for the entire year later on, the seller has to credit the buyer for their share from January 1st through May 14th, right now at closing. Here's a crucial exam tip that's going to save you so much time and stress. Because the buyer ultimately pays the bill, the seller credits the buyer for their share. This means almost every single tax proration question you'll see on the exam will result in a debit to the seller and a credit to the buyer. The only time this isn't true, the one exception to the rule, is if the closing happens after November 1st and the seller already paid the tax bill early to grab a discount. In that rare case, the whole thing would flip.
Section 4. Handling rental income.
All right, let's shift our focus from expenses over to income because the logic here is completely inverted from property taxes. Just think about how rent works in the real world. Rent is generally paid monthly, and it's paid in advance, right? The tenant hands over the check on the first of the month. So if closing happens on the 15th, the seller has already pocketed the cash for the entire month. But the seller doesn't own the property for that second half of the month. The buyer does. Therefore, that rent belonging to the buyer after closing has to be handed over. Since the seller got the whole payment up front, the seller must credit the buyer for all the days after closing.
The math here is honestly incredibly straightforward. Step 1, take the total monthly rent and divide it by the exact number of days in that specific month. That gives you your daily rental rate. Step 2, you just multiply that daily rate by the number of days allocated to the buyer. Boom, that gives you the exact amount the seller needs to hand over to the buyer as a credit while the seller takes the debit. See? A perfect balancing act.
Section 5. Interest on assumed loans.
So this final heavy-hitting topic comes into play during a very specific type of transaction, one where a buyer actually takes over or assumes the seller's existing mortgage. Now, here is a phrase that should sound pretty familiar to you by now. Mortgage interest is typically paid in arrears. Just like our property taxes, the accrued mortgage interest for the month of closing hasn't been paid yet. When you make a mortgage payment on the first of the month, you're actually paying off the interest for the previous month. Because that interest is paid in arrears, the buyer is going to be the one making the next full mortgage payment on the first of the following month. But think about it. Part of that payment is covering the time the seller still owned the property. So naturally, the seller owes the buyer for that accrued interest. The end result? A debit to the seller and a credit to the buyer for the days the seller owned the home during that closing month. To find the exact proration amount for the closing statement here, we use a very familiar formula. Step 1. Divide the monthly interest amount by the number of days in the month, which gives you the daily interest rate. Step 2, multiply that daily rate by the number of seller days. And hey, be incredibly careful here to double-check which party owns the day of closing according to the contract, because that is going to determine your exact seller day count.
Section 6. Summary and exam strategy. To bring this entire blueprint together, I want you to constantly anchor yourself with 3 core questions whenever you face a proration scenario. Seriously, ask yourself these every time. First, who owes the money? Second, who receives the money? And third, arguably the most important one, has it already been paid? If you can identify whether an item is paid in advance, like rent, or paid in arrears, like taxes and mortgage interest, you are always going to know exactly who gets the debit and who gets the credit.
So you now have the fundamental logic to ensure any real estate transaction is fair, balanced, and perfectly calculated. You know exactly how to keep those scales completely even. But the real question is this. When you finally sit down at that closing table in the real world and the numbers start flying, how quickly will you be able to spot the hidden arrears? Take these tools, confidently apply this logic on your exam, and I'll see you in the next lesson.